All right. Good morning, good afternoon, everyone. My name is Patrick Marcinko. I'm an associate here at Bogart Wealth. We just opened the seminar. We have some folks still coming into the meeting, so we'll give them a few seconds and get started here pretty soon. So be right back. All right. It looks like we have most of the folks in the webinar, so we're going to go ahead and get started. For those of you who don't know me, my name is Patrick Marcinko. I'm an associate financial advisor here at Bogart Wealth. And today we're going to spend some time talking about why you should consider a Roth conversion. Does a Roth conversion make sense for you? We'll go into the details of all of that. Feel free to, at any time, we have a question and answer box. Submit any questions, or if there's something that you want us to review in more detail, we're more than happy to. So with that, why don't we get started? So for those who might be new to our firm, our mission is to help clients achieve financial peace of mind, and we do so by preserving and maximizing intergenerational wealth. A little bit more background about us. We have about $2.4 billion of assets under advisement, including approximately $1.6 billion of assets under management, working with roughly 1,200 or so households. We are a registered investment advisor, which means we are an independent fiduciary advisor. What the fiduciary advisor component means is that we work in your best interest. Another unique aspect about our firm is that we custody assets at Charles Schwab for your protection. They're a very large asset manager, and that's who is our custodian. And one of the things that I am very proud of with the firm is that we are a fee-only wealth management firm. So we take the fiduciary standard to heart, and you'll see at the bottom, we try and be as transparent as possible, where we are only fee-only and there are no commissions or incentives that we receive working with clients. Bogart Wealth has 3 offices, one in McLean, Virginia, one in Houston, Texas, downtown, and then one up in the Woodlands. We have been growing over the past couple of years. We've been growing a lot. And so I wanted to share a quick snapshot of all of the advisors that we have on our team. Some of these advisors are located in the McLean, Virginia office where I'm located. We also have some in Houston as well as the Woodlands. If there's anybody that you'd like to learn more about, each one of us have a profile on the website as well as our contact information, and please feel free to reach out. We also have a full operations and financial planning team here in our Virginia and Texas office as well. You may hear from some of these folks. In addition to that, we are very proud to have our investments managed in-house. And so this is our investment team who sits in our McLean, Virginia office. Not pictured here, we also have a local CPA firm in Texas to help our clients with tax preparation needs as well as tax planning needs. So let's talk about kind of what we do. And so for those of you who work with us, planning is truly at the heart of what we do. Now, most people think that planning for retirement is just about the investments. It's about the portfolio, kind of the composition, asset allocation. But what we want to highlight here is that everyone's situation is very different. And it's important for us to focus on your goals and manage the issues that are most important and top of mind for you. So if you're new to Bogart and you have not gone through our financial planning process, and we'll talk about this kind of later in the presentation, I encourage you to reach out to one of the advisors pictured before or myself. We're always happy to talk specifically about what you and your family could be working towards. So with that, that's a little background on the firm, and let's get started with what the bulk of today's conversation will be. And so to start, one of our calls to action here at Bogart is focused on educating our customer base as well as our prospective customer base. And we do an extensive series of educational events, including the retirement planning timeline, retirement income planning, Social Security planning, tax law changes, estate planning, NUA and post-retirement strategies. NUA stands for net unrealized appreciation. Long-term care insurance planning, Roth versus traditional 401k and IRAs. We'll go into that in great detail this afternoon, as well as mega backdoor Roth conversions. So in terms of today's topics and the specific agenda items we have, we want to talk about numerous different things, but our focus will be talking about the differences between Roth and traditional IRAs, and ultimately why it should make sense to consider doing some Roth conversions now. And so what we're going to cover is we're going to talk about tax optimized accounts, backdoor Roth IRA contributions. We won't go super in depth on this, but we will talk about it, Roth conversion strategies, as well at the end. We'll have a section of question and answer. So let's talk about now qualified accounts. And when I say qualified accounts, I'm referring to retirement accounts. So think traditional 401k, traditional IRA, a 403b type of account, 457b accounts. And so many people are familiar with these accounts, but let's highlight what are the good part, what are the advantages of these accounts? And the first advantage is salary is contributed on a pre-tax basis, meaning that the contributions to the account are done before you pay taxes. So it actually brings down your taxable income. And by doing so, you ultimately save in taxes every year while simultaneously saving for retirement. So there's a lot of benefits on the front end with the contributions. Now, let's talk about what happens once the money is in the account. Well, once the money is in the account, it's growing, it's invested, you'll pay no tax on the appreciation. You'll also pay no tax on the dividends along the way. So while you're saving for retirement, there should be no taxes. In addition to that, one of the most important things that we talk about with clients is company match, and specifically as it relates to the traditional 401k. For example, you may contribute a 3% of your salary to your 401k, and your employer may also match 3% of salary as well, as long as you do. And so this can be a very powerful addition to your retirement savings. And so if there's ever any question about how does your company match work, what might it be, we're always happy to review and give you our thoughts, because it is a very powerful addition to the contributions that you make. So let's now shift our focus a little bit to, okay, there are a lot of advantages to the traditional 401k IRA. What are some of the other considerations that we need to be very mindful of as we use and invest inside these accounts? The first is, because we're deferring taxes, we're not paying taxes when we contribute, we're not paying taxes while the account grows, there is going to be, for that benefit, the IRS imposes a tax penalty if the money is taken out early. What does early mean? Early means if the funds are taken out prior to age 59 and a half. And there are some exceptions to that rule, and that's beyond the scope of what we're going to get into today. But the primary rule is prior to age 59 and a half, the penalty for any withdrawals will be 10%. After 59 and a half, that 10% penalty goes away. And the kind of overarching thought behind that is these dollars are designed to save for retirement. They're designed to be saved for later years, which is why the government has that penalty put in place. Now, we talked about the tax benefits. Okay, when contributions go in, they're not taxed. In fact, we get a deduction. And then during the investment process where we have the appreciation, there's no tax owed. But when we take money out, when it's a withdrawal, and this applies to both the contributions plus any growth that we've had, the full amount rather of the withdrawal is going to be considered ordinary income. And so let's say that you were to take $10,000 out of an IRA or 401k, all 10,000 of that will be considered ordinary income. One other aspect, and this is a very important component of what we're going to talk about today, is required minimum distributions. And so because we're deferring taxes in these accounts, the government eventually decides, hey, at some point we want you to take a withdrawal from this account so that there can be taxes on those withdrawals. And so there becomes a certain point, and right now it begins at age 73, where the government says a fraction of the account has to come out every year at that age. Now, we'll talk about the details about that, how that can impact your situation, but this is a very important thing to note, because the penalty, if we don't take a required minimum distribution in the year we're supposed to, can be very severe. In fact, the penalty right now is a 25% tax penalty for failure to withdraw on schedule, meaning within the designated period. If you have any questions about what your RMD may be, when do you need to take it, please feel free to send us a note. We're more than happy to talk about that and review what your situation may look like. So let's talk about, okay, we know kind of the basic mechanics of the plans, how they work, the advantages, considerations we need to have. Let's talk about how do we get money into it and what are the limits. So beginning with the traditional 401k, 403b, Roth 401k, under the age of 50, the contribution limit for this year is $22,500. Now, for those that are over the age of 50, the catch up for individuals is an additional $7,500, which brings, if you're over the age of 50, you can contribute $30,000 to these accounts. Now, that applies to all of them together. So if you have a 401k and a Roth 401k, the limits are an aggregate. It's not $22,500 for each. Now, you'll see in the third row, there's a defined contribution plan limit of $66,000. You may wonder, okay, well, if I can only put in $30,000 if I'm over the age of 50, how do they have this limit of $66,000? And that's a great question. And for that, we're actually going to jump to the next slide. So just to recap, those under the age of 50, pre-tax and Roth contributions that you can make is $22,500. Over the age of 50, the contributions you can make are $30,000. What the $66,000 limit for those under the age of 50 includes, it includes both the pre-tax and Roth contributions, but it also includes the company match. So we talked about how for certain type of accounts, the employer will match. If your employer puts in money, that's going to count towards that $66,000 limit. Now, there is also a portion, and we'll get to this at the end, where there's after tax. So let's say that you put in $30,000, you've maxed out pre-tax. For some 401k plans, you can actually put in more than that on an after-tax basis. So the combined total of all sources of contributions between pre-tax, Roth, after-tax, and company match is $66,000 for those under age 50. Over age 50 with the catch-up, it's $73,500. And there was a question that came in talking about catch-up contributions. So catch-up contributions will be pre-tax. That is correct. So traditional IRAs now, similar tax treatment where contributions could potentially be deductible, they're pre-tax, and then the growth is not taxed until withdrawals. The caveat with traditional IRAs and how they're different from traditional 401ks is two things. Number one, it's the limit. So for a traditional IRA, in order to contribute, you must have earned income. So in order to contribute $6,500, at some point during the year, you also have to have $6,500 or more of earned income. There is an earned income limitation for these type of accounts. The question becomes, is the contribution to the IRA going to be tax deductible or not tax deductible? You'll notice the limits are the same. So for those under the age of 50, it's $6,500. The catch up this year is $1,000. So $7,500 total for those over the age of 50. Now, what does it mean for it to be deductible? Let's assume that you were to contribute to an IRA and you're under the age of 50. So you do the $6,500. Well, whether or not you get a $6,500 deduction on your taxes is going to be dependent on your income. So if you were a single filer, you made, for example purposes, $100,000, you would be phased out under these limits of $83,000, and if you're a joint filer, $136,000. So you would not be able to take a deduction for the traditional IRA on your taxes. Now, there are certain ways to work through that, and we'll talk about that at the end. But in order to get that deduction, there are income limits that we want to be aware of. So if you have any questions about what income may be and whether your traditional IRA contribution will be deductible, please feel free to let us know. We're happy to help work through that. So shifting now, so we've talked about traditional 401ks, traditional IRAs. Let's talk about Roth 401ks and Roth IRAs. The big difference with these type of accounts, with Roth accounts, anytime you hear the word Roth, we should think salary is contributed on an after-tax basis. Now, the company match will likely still go to a pre-tax traditional 401k, but because we're paying the taxes up front, what you'll notice is the growth is tax-free, but the withdrawals of growth where we have the portfolio exceed the principal amount, if we meet a certain holding period requirement, those withdrawals are going to be tax-free as well. So we're effectively paying taxes on the front end, and then the withdrawals at the back end are going to be tax-free. And so you'll notice, okay, growth is going to be tax-free. Withdrawals of principal, so how much you put in, will always be tax-free, and growth will be tax-free. And let's talk for a second about the holding period requirements. Similar to traditional IRA, the 10% penalty will be subject to withdrawals if it's under the age of 59 and a half. So if you're over that, there will be tax-free withdrawals of growth. And one thing that's not with a traditional IRA, but is with a Roth IRA, the account has to be in existence for 5 years. There's been a recent change, but Roth IRAs are not subject to required minimum distributions. That is unlike the traditional 401k, which is a huge advantage, something we'll talk about in a case study a little bit later. But the change that I mentioned, beginning in 2024, Roth 401ks will also no longer be subject to RMDs. So these first 5 bullet points really illustrate the power of investing in a Roth IRA and the tax advantages in retirement of having growth be tax-free, having withdrawals of principal and withdrawals of growth also come out tax-free. Now, the final bullet point we want to talk about and highlight is that with Roth accounts, the beneficiaries of a Roth account inherit the money tax-free, meaning if they get $100,000 in a Roth IRA as inheritance, that $100,000 will not be taxable to them. Now, there is a schedule in which they have to take the money out of the Roth, but the withdrawals for the beneficiaries will not be taxed. They will be tax-free, which is a huge advantage and one of the big considerations that we want to look at when evaluating, do Roth conversions ultimately make sense for you? So again, the Roth IRA here is contribution limit is $6,500. The catch-up for the Roth at age 50 is $1,000. Now with Roth IRAs, there are only 2 ways to get the money into a Roth IRA. Number 1 is the Roth contribution. The second is a Roth conversion, which is the purpose of today's conversation. If you do a Roth contribution, though, directly to the Roth, meaning let's say you take it from your checking account, put it right into a Roth, you are going to be subject to income limits. This year for 2023, if you're a single filer and you make more than $153,000, you cannot contribute directly to a Roth IRA. Similarly, if you're joint, you make over $228,000, joint filer, that is, you will not be able to contribute directly to a Roth IRA. So how do we get dollars into a Roth bucket? Well, enter the Roth conversion. And there is no income limit and no limit on the amount of Roth conversion that can be done. So this is really the way that we are able to work around some of those income limits with contributions. Okay, let's talk about, I've talked about Roth conversions, but what is a Roth conversion? And put simply, a Roth conversion is a penalty-free taxable transfer from a traditional IRA to a Roth IRA. What does that mean? We're taking money from a traditional IRA and converting it to a Roth. And when you convert the money to Roth, you can do so either a portion of the IRA, or you could even do the full IRA. It's no requirement there. But when you convert from, again, a traditional IRA to a Roth IRA, you're going to pay taxes on the amount that was converted. So if you did a conversion of $20,000, $20,000 is going to be considered taxable to you. I know I've talked a lot about, okay, traditional to Roth, but it's not just traditional IRAs. In addition to a traditional IRA, you might be able to convert, what would be this bottom table to a Roth IRA. That would include 401ks, 403bs, simple IRAs, 457 plans. There are a lot of different opportunities here for that. Perfect. So this is a really nice slide. It emphasizes some of the benefits of Roth IRAs. I won't bore you reading every single line, but what I want to draw attention to is the emphasis here is you can do Roth contributions at any age, and contributions plus growth come out tax-free if after 59 and a half, and the money has been in the account for 5 years. And there are no RMDs during the owner's life for Roth IRA. So there is a lot of benefits to having money inside a Roth IRA. So let's talk a little bit now about, okay, why would we think about converting? Well, the first reason is for your personal situation, if we project income tax rates will be higher in the future, that would be a good reason to convert at lower tax rates today if we think you're going to be in a higher tax situation in the future. Another situation where we see people looking to convert is if they expect their income or spending to go up significantly faster between now and the end of their financial plan. In addition to that, let's say, and right now we're in a period where we still have kind of a low structure of tax rates from the Tax Cuts and Jobs Act. That eventually will sunset back to the old rates. And so if we see all income tax rates go up, that could be a case where in a period where we have lower tax rates, we might want to consider doing Roth conversions. And the final one, or really final one on the RMD side is, okay, if eventually the government is going to require you to take RMDs, some of the IRA accounts get, to a value where the RMD amount that's being required to take out is much greater than what's needed in retirement for living expenses. And so what we see is if someone needs to pull out, call it $60,000 a year for living expenses, their RMD is double that. And what that's effectively causing is they're having to pay more in tax and pull more out from their accounts than they need to. This is referred to as surplus RMDs. What shifting money from the traditional bucket to the Roth will do is it will help reduce this surplus of RMDs. That way, during retirement, we're not having to be forced to pay more in taxes than we should. And the final component, this is a very large one for a lot of folks as we think about legacy planning and estate planning. If you anticipate leaving a large legacy to family and individuals and ultimately the beneficiaries, a Roth, again, is tax-free. So it's something that we want to seriously consider doing at lower tax brackets today versus passing pre-tax traditional IRAs. I mean, it looks like there is a question coming in. So the question was about no limit to Roth contributions, but there is a limit on the traditional IRA. So Roth contributions, they do have a limit. Traditional IRA contributions, Roth conversions do not have a limit. Traditional IRA contributions do have a limit. We can review that again in a bit. So talking a little bit about the progressive tax bracket systems. We know in the US that our tax structure is progressive in nature. And what that means is that we go from the 10% bracket to the 12, to the 22, to the 24, to the 32, 35, and ultimately we work our way up here to the 37% tax bracket. And because the nature of these tax brackets and the way we have a progressive system, it is 1,000% favorable to save to a 401k when you're in these higher bracket years, because contributions are made at the highest marginal tax bracket. Let's talk about that a little bit. So let's assume, you're married filing jointly. You are very fortunate to make, call it $400,000. If that was the case, your marginal tax bracket here would be 32%. If that is the case, that does not necessarily mean, though, that you pay 32% on all of your income, because the first 22,000 is taxed at 10%. The next bracket, so between 22 to 89,000, is taxed at 12%. From 89 to 190 is taxed at 22. From 190 and so forth. So what we see, though, is when we do a contribution to a 401k, what we're doing is we're reducing the highest level of income that we have, which is reducing taxes at our highest marginal tax bracket. So we're getting the biggest tax benefit by contributing to an IRA, 401k rather. But then let's think about, okay, when we pull money out of a IRA, the marginal tax rate is not. So let's say if we were to pull out $100,000 from a IRA, in that case, you'd be in close to 22% tax bracket. But that doesn't necessarily mean you're going to pay 22%, because again, we're paying 10% on the first 22,000. The next chunk we're paying 12%, and then over that we're paying 22. So the average of those, the effective rate is much lower. And so just to recap here, it is better to make contributions at the highest tax rate, where you're paying the marginal tax rate, because withdrawals are ultimately going to be made at that average or effective tax rate. And this is just talking about, for most people, RMD surplus, where we're having to be forced to take out more money than we need in retirement. Big solution for that would be to think about Roth conversions, and we'll illustrate that in a second. So the decision that we need to make is ultimately looking at, does a conversion make sense? Does it make sense to convert from a traditional IRA to 401k over to a Roth? And so to pause there, everyone's situation is going to be different. And obviously we need to look at, kind of where your current tax bracket is versus where we think future tax brackets are going to go. That's the first component. But we also need to understand time horizon, because we want the assets in the Roth bucket to grow tax-free. And so we need to make sure there's a long enough time horizon to recognize that benefit. But we also need to think about, okay, if we do a conversion, we have this taxable amount go through, where is the money going to come from to pay the tax bill? And so we need to make sure there's money set aside to pay taxes on the amount that we convert. So let's start and look at a kind of a case study that we've seen recently. So we were working with folks kind of in this example where they had identified one of their goals was legacy plan. They wanted to make sure that a lot of dollars were able to pass to the beneficiaries the most tax efficient way. And so we said, okay, well, if we do nothing, if we do no conversions, what does that look like? Well, you can see that, the portfolio grows very healthy. The plan looks really good. And of the assets, so taxable, which get to step up in basis, tax deferred, which will be taxable upon inheriting as beneficiaries, plus the tax-free here of about 1.4 million, that's a healthy number. But we were curious, okay, if we did Roth conversions, how would that impact the legacy planning? And so we did an assumption where we said, okay, let's do Roth conversions going up to the 22% tax bracket. And for each year, we illustrated kind of different amounts of conversion, ultimately converting all the way through the year 2029. But you can see now at the end of the plan, the tax-free amount that is being passed on through beneficiaries is much greater, just kind of shown by the growth in the orange segment, than what it was before. And we can also see that we didn't sacrifice really anything from the total portfolio value at the end. And what we're doing here is we're shifting where taxes are being paid and kind of shifting the tax allocation to optimize it over the long haul. And so this really did achieve, okay, if the primary focus is to pass assets tax-free, doing Roth conversions greatly adds to that. Now, one thing we wanted to look at though was, okay, how does that impact RMDs? Because while yes, legacy planning is a big focus of the analysis, what we noticed is that by doing the Roth conversions, we actually saw the RMD requirements be much less. And again, when we have money in the pre-tax traditional bucket, what we see is those assets are going to be subject to RMDs. When we move them to Roth, there's no requirement for RMDs. And so beginning at this client would have RMDs due at 75, we noticed that the RMDs were much lower for the life of their plan than otherwise stated. And so we saw that the total RMDs that we estimate taken over the life would be about $3 million less just by doing Roth conversions. Now, the Roth RMD is tied to taxes, but it's not necessarily on the taxes that they would pay. So then we looked at, okay, what does this look like from a tax perspective, potential tax savings? Well, we saw, okay, in these years where folks were recently retired, let's do Roth conversions while income is very low, taxable income is very low. Let's increase taxes by doing Roth conversions, but still keep taxes in lower brackets by converting. But then ultimately what we see is this helps reduce the total lifetime tax burden here with the yellow. Because you see this spike, this is directly correlated with RMDs being due. And this is where we get that surplus, where RMDs now are at a point, they're much more than we need to take out of the portfolio for expenses, and they're causing taxes to really, really spike. And so by bringing some of this tax liability forward into the earlier years where income is lower, we're ultimately saving a lot in the later years. And that really doesn't factor in as well the fact that we're transitioning the balance sheet to be much more friendly to the beneficiaries, going back to the slides from earlier. And this is just showing effective tax rate, effectively the same slide. And we also kind of look at, okay, what is the break even here? And we see that, okay, we're paying taxes earlier, but with the portfolio growing at an assumed 5.5% return, we do see a shift where ultimately there will be rather significant tax savings through these projections over the client's life. So just to recap, what we were able to see in that analysis is really twofold. Number one, we're able to minimize the amount of RMDs that are going to be paid during the client's life, where that's going to save them taxes tremendously so, but we're also doing so in a way where we're actually shifting the way the balance sheets comprise between taxable, tax-deferred, and tax-free assets to really maximize that tax-free bucket. So from a legacy perspective, the beneficiaries inherit the money, no taxes, and it's a much more friendly asset to inherit versus a pre-tax asset, which would be taxable to them. And so it's really taking the tax burden off the beneficiary. So those are the two goals that we were able to accomplish in that analysis. So one question that did come in, is it possible to use a RMD to convert to a Roth? The answer to that question is no. So what happens if you're doing Roth conversions when you're taking RMDs, what has to happen is you take the RMD amount, but then any conversion that you want to do has to be in excess of the RMD. So if the RMD is 10,000, you can convert any amount taken from the IRA over 10,000. So it is a little nuanced there, but you cannot take a RMD and convert it to Roth. That is not a function at the moment. So we did talk a little bit earlier in the presentation about the income limits, kind of the restraints around getting money into both traditional IRAs from a deductible front and then ultimately to Roth. So one of the strategies we wanted to highlight, and we won't go super in depth with this today, but ultimately is the backdoor Roth contribution. How does this work? So let's assume that you make a non-deductible contribution to a traditional IRA, meaning that your income limit is high enough where you don't get any tax deduction. This is what we refer to as kind of the front door deposit. So money goes into the traditional IRA. Again, you don't get the deduction because your income is over the limit. But then what we do is we take, after kind of a quick pit stop here, we convert the amount in the traditional IRA over to a Roth IRA. And it's a kind of an immediate conversion. This is called the backdoor deposit or the backdoor conversion. By doing so, we're able to pay taxes now on the traditional IRA, and then going forward, the money is going to be housed in the Roth IRA. So any growth, any appreciation, any subsequent withdrawals, pending we meet 59.5 in 5 years of the account being open, will be much more advantageous in the Roth IRA. So just because you're over the limit, income limit on being able to contribute to a Roth IRA, or you're able to get a tax deductible contribution to a traditional IRA, doesn't mean there's not a way to get money into a Roth IRA. We have a lot more that we could go into on this, but I'm going to kind of keep it high level at the moment. And similar, inside a 401k, the after-tax contribution going back, that would be in excess of a direct pre-tax or Roth contribution to a 401k, and that's the 22,500 number. But let's say that you wanted to contribute even more. What we could do is we could contribute after-tax money, meaning you contribute to the 401k, but you don't get a tax deduction on the front end. This is considered the kind of front door deposit to the traditional 401k. It has a quick pit stop here, but then we can take that money and do a backdoor deposit over to a Roth IRA and Roth 401k. One of the advantages to doing this is because when you have after-tax contributions in a 401k, the contribution itself is after tax. It will not be taxed upon withdrawal, but the growth of that account would be. So any growth on after-tax contributions inside a traditional 401k will ultimately be subject to taxes. Where if we were able to do that direct rollover and do the backdoor deposit to a Roth, if the growth happens inside the Roth IRA or Roth 401k, what we see at that point is that any growth is tax-free. And that's why we'll consider shifting money from after tax inside the 401k to the Roth IRA, because again, both contributions and the growth in that vehicle will ultimately be tax-free. Now, all of these strategies that we talked about today are unique to everyone's specific situation, and the amount of conversions or whether you could whether converting makes sense is going to be unique to you. So if there's any questions, please feel free to let one of us know. We're always happy to do a one-on-one financial strategy session with you. And with that, we want to just add that you're welcome to contact us if that would be of interest. We have 3 offices again, one in McLean, Virginia, one in Houston, Texas, one in the Woodlands. Our number is there as well. So with that, I want to thank you all for joining today. I hope that this was informative on multiple fronts, but thank you very much for joining. And if there's any questions, please feel free to let us know. Thank you very much.